Hello guys, so I'm going to use this video to explain the rising channel, the falling channel, the bear flag, the bull flag, and I'm also going to talk about the false breakout and the volatility contraction chart pattern. So in the first in the first part of the video series, I have discussed and explained the ascending triangle, descending triangle. Also talked about rising and falling wedge, and we also discussed and illustrated a symmetric triangle. So for this video, uh, I'm going to focus on the flag patterns, that is the bull flag and the bear flag, volatility contraction chart pattern. I'm also going to talk about false breakouts. Then I'll talk about the rising and falling channels. So let's start with the rising and falling channels. So for the rising channel, you have something like this. You have something like this. You have two diagonal trend lines. If you plot it on your chart, you are going to have two diagonal trend lines, and price is going to move towards it like this, up, down, up. So price is going to be moving through the channel like this. So this is a bearish reversal pattern. So in a downtrend, this pattern usually almost 90% of the time breaks down. Like when you add the 200 period moving average to your chart and it is below your price is below the 200 period moving average, then this chart pattern is going to break down because it is a bearish reversal pattern. So that is how it forms on your chart. Let's say this is a downtrend, this is your 200 period moving average, and here is price coming down and it starts forming this channel. So because it's a downtrend and this is a bearish reversal pattern, chart pattern, then it breaks down and the price will break down. So when you see this rising channel on your chart, you want to be shorting the breakdown. You want to be prepared to sell the breakdown. So the other chart pattern I'm going to discuss about is the opposite of this one, which is the falling channel. So for falling channel, you have something like this. You have something like this, a trend line. That is how you are going to identify it on your chart. You have a trend line like this and another trend line, both parallel to each other. So let's say this is an uptrend. This is your 200 period moving average, and let's say that's your 200 period moving average, and let's say that's your 200 moving average, and price starts to go up, then it's the upper trend line channel and it retraces down. So this up price is going to be moving through the channel, up down, but because it's a falling channel, you can see it's sloping down, unlike the first one that was sloping up. So if you find this chart pattern in an uptrend, it usually just break upward because it is a bullish reversal pattern, and bullish reversal patterns, they are stronger in uptrend. So let me illustrate it again. You have a falling channel like this, indicated by two trend lines. Let me make it more steeper. So let's say you have it like this. This is your 200 period moving average and price is above it. So price is moving through the channel like this because it's an uptrend and this is a bullish pattern. Anytime you see something like this, it also looks like another variation of the falling wedge. So the falling channel and the falling wedge are like almost the same. They are both a bullish reversal pattern. So it breaks up usually in an uptrend. So why in a downtrend it usually just breaks down 50-50. In a downtrend it could break towards the upside or downward, but it's usually 50-50. So let's say this is a downtrend, the price is below the 200 period moving average and price is moving down like this through the channel. Because it's a downtrend, it has a 50% chance of breaking down and also 50% chance of breaking upward. So that's all for the falling and rising channels. So the next chart pattern I'm going to talk about is the bull flag. So the bull flag looks like this on your chart. The bull flag looks something like this on your chart. It's like a flag. So you see the bull flag after uptrend. So let me just try and illustrate an uptrend. Let's say price is going like this. Let's say you have a resistance over here and price breaks above resistance. So the next thing that will happen is that it's going to start forming a flag pattern like this. So you see it in an uptrend. Let me just try and illustrate it again. Let's say you have a price trading. Okay, let's say this is your resistance and let me just try and illustrate how a flag is going to be. So you have something like this, like a falling channel or a falling wedge or a symmetric triangle, but you have something like this. So a bull flag, let's say this is your 200 period moving average, is an uptrend and price is going up, price is trending up and it breaks above resistance. So the next thing is that it's going to start consolidating between this channel. Volatility is going to reduce over this channel. So that's now what we call bull flag, because it looks like a flag. You can see it looks like a flag. So that's what you call bull flag. So price is going to be consolidating within this channel like this. Then because it's a bull flag and it's an uptrend, so it tells you that the trend is going to continue upward. So it usually just breaks towards the up and trends continue. So that's how a bull flag forms on your chart. And so in case you want to go long on this chart, this you can go long and put your stop loss 1 ATR below the swing low, let's say somewhere here, and you go long. So that is it about a bull flag. Let me try and illustrate it again. Let's say you have your resistance over here, and let's say this is your 200 period moving average, price is above it, it's an uptrend. So bull flag is going to be just a consolidation like this, a little consolidation that looks like a flag like this, looks like a falling channel. So price is going to be moving towards, and once the price breaks above resistance, it's going to go up, then it's going to start consolidating within the channel like this. Then Bull flag is a bullish continuation pattern. So it's just telling you that over here volatility is going to reduce because the range of the candles are going to be smaller. Then the next thing you are going to see is that price is going to break up above the flag. So that's how bull flag is. So these lines that I'm drawing are basically your candlesticks. So just visualize it, or maybe your line chart. So for the bear flag is just opposite of the bull flag. Let's say this is your support. So for the bear flag you have something like this. You have something like this. So you see bear flag in a downtrend and bull flag in an uptrend. So let's say this the 200 period moving average. That means it's a downtrend already, and price is going to be moving like this downward. Is trending downward, then it breaks below support. Then the next thing is going to start consolidating within this channel, and because it's a bull flag, is volatility is going to reduce for a while. The candlestick patterns are going to get smaller over this channel over here. Then what is going to happen next is that the flag is going to break down. So bull flag is just opposite of the bear flag. Bear flag is just the opposite of the bull flag. So let me illustrate it again. Let's say this is your support, and a bull flag is usually like this. It usually looks like a rising channel on your chart. It looks something like this. So what happens is that, let's say this is a downtrend and price starts going down, test support, then breaks down. So what is going to happen is that the price will start consolidating within this channel and finally breaks down. So that is a bull flag, and potentially the price could just go down again and form another bull flag and still go through it and break down till the trend starts reversing. So you see bull flag in downtrend, bear flag in downtrend, and a bull flag in uptrend. So bull flag is a bullish reversal pattern and bear flag is a bearish reversal pattern. So the next chart pattern I'm going to talk about is a volatility contraction. So volatility contraction looks like this on your chart. Let's say this resistance, and the lower one I'm going to put here is your support. So what volatility contraction means is that price is going to be moving through this support resistance. So over a period of time the volatility is going to reduce and price is just going to be moving a little bit like this through this support channel before it breaks upward. So we call this build up. We call it build up. So what just happened over here is build up. It shows you that buyers are willing to buy at higher prices. So you have a build up around resistance. Let me just illustrate this again. So let's say we have a let's say we have a resistance over here and we have a support over here. So and we have something like this. Let me use this to reference the volatility contraction. So what is going to happen is that price is going to be moving through this support resistance. You can see that over here the range of the price is very large, like the volatility is very large. Then what happens next is that prices will now start contracting over this consolidating over this point. and volatility will reduce over here. When you see this around resistance, it is bullish, especially in uptrend. I mean, uptrend is when price is above a 200 period moving average. So this thing that is forming over here is called a build-up, and you can also say volatility is contracting because the range of the candles over here are larger than those over here. So what is going to happen next is that the price is going to break towards the upside. So that's the volatility, contraction, and a build-up. So in case you want to go long on this thing, on this chart pattern, you can put your stop loss around here and go long, like 1 ATR below the swing low, and go long and buy. So that's a volatility contraction. So volatility contractions chart pattern around resistance. So let's do another one around support. So what happens that you have your support resistance, then let me reference it like this. So what is going to happen is that, let's say this is a downtrend, price is below 200 period moving average, and price is moving like this. Then it starts consolidating over here. It starts consolidating, showing you that buyers, sellers are willing to sell at this lower prices around the support. Then it breaks down. So what this thing that you have over here, this contraction over here, is called build up, and it's very important in trading. So another place you can have a volatility contraction is, let's say trend, you have a trend line like this. So you don't just have it around there, just horizontal support and resistance. You can also have it around the trend line. So let's say the price, you see, so let's say this is an uptrend, and price is moving like this. So over a period of time, it's going to start. So that's a sign of strength. It's telling you that buyers are willing to buy at this prices here, and it usually breaks up in uptrend. So the next chart pattern I'm going to talk about is false breakouts. False breakout. So false breakout is when, let's say you have support, you have resistance, and you have support. False breakout is when price breaks below the support or resistance, then comes back into support and resistance. It's like bull trap or bear trap. Like price, let me try and illustrate it. So price is moving within this channel, then it breaks above support. So people are thinking that, okay, price has gone above support, that it is bullish, then they start buying at this point. But the next thing that is going to happen is that price starts going down. And move back into the channel. So let me illustrate it in a better way. Let's use arrows. What is this? Let's use arrows to illustrate it. So let's say price is moving like this, up, then down, up, then down. So what is going to happen next is that price is now going to, for this next candle, price will now break above the resistance, and buyers will start thinking that, okay, price has broken above the resistance, so they start buying. So what is going to happen next is that for false breakout, is that the next candle that is going to open is going to take price down. The next candle that is going to open is going to take price back into the channel. So that's false breakout. You call it false breakout because the price went above resistance, and the next candle or the next 2 or 3 candles came back into resistance and probably took this one down lower. So that's a false breakout for to around the resistance. And when this happens around resistance, we call it bull trap, because those bullish people that bought around here hoping that the price will still continue higher, they are trapped and they will have to stay and endure seeing the price going down like this. So this is a false breakout chart pattern. It's when price breaks above resistance and comes back into the channel. So this is a false breakout. So the next chart pattern I'm going to talk about is also false breakout, but in this case it's around the support. So what is going to be happening is that price will come down to support, then move back to resistance. That means you are like having something like a range. Move down to resistance, back to support, resistance, back to support. So this next candle here, this next candlesticks, all these arrows represent candlestick patterns. So it's going to break below support. It's going to break below support. Normally buyers are expecting it to just stay. Sellers are expecting it to just stay here and bounce back up like normal, like it has been doing. But what happens next is that the next candle breaks below support, and sellers, those that want to go short, the sellers, they will think that okay, the price is going to go down from here. But what happened next is that the next 1 or 2 candle is going to take the price back into the channel. So that's a false breakout. So for false breakout, you can also call it a bear trap, because those people that are bearish, that sold at this point, that started selling at this point thinking that the price will continue to go down, maybe lower like this, are trapped, and the candle reversed, the price reversed against them back into the channel. So that's all for this second part of this chart pattern series.